Hello, this is John Kvale, and this is our February capital market and financial planning review. I am still working on improving the product here. So those of you that haven't seen this, I've got this new wireless mic, and I've even got it's a little bit of a bright thing. I may need to wear some sunglasses on this thing, but I'm trying to also get the color a little bit better. So, on an effort of constantly improving, that's what we got going on. But hey, let's get to the video. So I'm going to shoot up over here with a little luck. There we are. And let's get to our February capital market and financial planning review. I'll move through this pretty quick. We do have four big subject matters and a couple of different swings on some of them. Those of you that are new, we do this in a video podcast type of review. We do it quickly because we know everybody's busy, and we do it in the podcast type of view so that people can be driving down the road and listening. And so don't take your hands off the wheel. I always say that, and I know it's silly, but I'm going to go with it anyway. All right, we do financial planning tips and then discussion of the capital markets. In our third installment of the Fun Back to Basics series, this one is debt planning. Our first one was emergency fund planning, and the second one was protection planning. This is debt planning, and I did the Clint Eastwood, the good, the bad, and the ugly forms of debt. You might be surprised to hear a financial advisor say that there is good debt. Predominantly education and mortgage can be good debt. I go into it in great detail. Those of you that are listening, I'm hovering over the post. I go over this in great detail with each, giving examples of the good, the good, and especially the ugly debt. Those are the two extremes. The ugly would be high interest credit cards, and this all speaks to having a good emergency fund, which was the very first Back to Basics series. So we hope you enjoy that. We're going to bundle this all up and likely have videos to go with each one for those someone that may need it in your life and find it helpful. Number two, this month, all of a sudden, boom, I believe it was on a Saturday morning, this review, that Social Security statement came in my email, and it made for a wonderful post. I did do, those of you that are listening, I am hovering over the link to that, and I'm also hovering over a snapshot of the reminder email. Cool thing about it, take 5 minutes out of your day, go into your Social Security statement and make sure that your hard-earned earnings have been credited. That we can debate the nuances of whether Social Security is going to be there or not, but at least get credit for it, because that was money that was taken out of your paycheck. So make sure that the Social Security Administration did tie your savings, your payments to your Social Security number for your Social Security credit. Also, one thing I'd like to say is that it changed dramatically from last year to this year. They updated the backdrop of it. There's a spot for, I mentioned it in the post. There's a spot for delayed benefits and a neat, actually I mentioned it briefly here in this, a neat spousal calculator. So well done there. All right, this actually, I'm moving on, scrolling, those of you that are in listen-only mode, I'm scrolling on down to capital market portion. And in this post, and I parlay this into a two-part series, in this post, which is the post concerning how, I did this early in February, how the markets, specifically the bond markets, the U.S. Treasury markets, the 2 and the 10s, front-run federal rate hikes and the economy. Broadly saying, the two-year Treasury yield front runs the Federal Open Market Committee spot front rate. Think your checking account. The 2-year has gone sky high, and telling the Federal Reserve that they need to, at least in its opinion, raise rates. We can debate the merits of that. That's not the subject of this. The 10-year has also gone up. 10-year is more economic, 2-year is more about the Fed funds rate. Both of these rates have gone up a good bit, and that puts pressure on our fixed income holdings in the beginning. So in the beginning, we get some pressure, but pressure meaning lowered values slightly, but then what happens is we get more income from them. So it's a little bit of a give and take. So if we see some lowering of value of our fixed income, that's what's going on. For the record, we think that we've talked about that, we're about to talk about that the economy is slowing, and if the economy slows, especially those 10 years will likely start rolling over and moving down. Okay, this is a post that I did very late. Actually, as I'm doing this, this post hasn't even posted yet. So I'm pulling the link. It's going to post the last day of February, but I thought it was timely because I got a few questions on it last week, and it's the snapback. The snapback is a beast that is known to only tramp around, not only, but mostly pile around during slowdowns. And I added this to our slowdowns, Anatomy of a Slowdown series to remind folks that when the capital markets are trying to find their way through an economic slowdown, and you notice I'm careful not to say recession. That's that R word. I don't like that word. Maybe we do, maybe we don't. We're not calling for one. We're just saying when things slow down, unlike in a normal market where they're growing, you get these massive snapbacks. Nobody knows exactly why they happen. There's a lot of theories, and I'm sure one of them may be right. I pulled back the uniquely quick chart of March of 2020, and there was I had no idea what it was. There was a 4.87% snapback. Then right after that, there was a almost 6%, and then lastly, there was a 10% snapback. And these are the major capital markets. Don't usually see that in normal markets. Markets trying to find themselves. We do think that things are very likely slowing, and we do think that this may be a normal, more long-term period of time. So I just wanted to give some context of what these snapbacks. In this case, last week we had a big snapback when the word was that Russia was invading Ukraine. One of these snapbacks, I don't remember which one it is that I've posted here, was also on the same day that we received the worst unemployment report we'd ever had, the most unemployed people during COVID and the lockdown. So the snapbacks can agnostically not listen to the headlines, causing some puzzle. You're like, wait a minute, the house is on fire, but why are the markets going up? Just it's part of the way this works. Those of you that are in, and nobody really knows, those of you that are in listen-only mode, I'm going back to the top of this post. I hope you've enjoyed it. We've got our arms around this new audio. I'm really happy with it. Hopefully I can see after I've got this light on me and it came for a better picture. We'll talk to you in March, and I'm getting started on the newsletter, so we've got some great stuff. Thank you for your time. Thank you for everybody. Have a great day. It's a cold Saturday weekend here, so I'm doing this a little bit early. Enjoy. Take care.